So how does it work when you've got a mortgage, but let's say it's a lower mortgage, $1 million home valuation, but your mortgage is $500,000. How do you access the equity from that for an extension or renovation to your home, or it might be you're buying an investment home, or how does that sort of all work?
A couple of different ways to answer that, but I guess the starting point that I would make most people aware of is that the equity in your home, technically what you're doing there when your house goes up in value, your loan goes down, you're building up this equity in it. And that equity, really, the way I look at it, that's a vehicle for you to do whatever the next transaction might be. So if we're talking about $1 million asset or $1 million home value, and we've got 500,000 owing on it, general rule of thumb is that we can go up to 80% of that value. So up to 80% of $1 million property is 800,000. That's how much we can borrow against that home before we actually get charged things like mortgage insurance and stuff like that. So ideally we want to try and avoid that because that's going to be extra fees and a higher interest rate and those kind of things.
So you get 300 grand in equity because
correct.
The 80% minus what you owe.
Yes, and that's exactly how it works. Is you borrow this 800,000 is the max we can borrow against the house. So if that's the case and you've already got 500 owing, 300 is the extra we can get out. Now depending on what the plan is with that 300k will depend on how we structure that loan. If that 300k is a deposit on an investment property, we'll keep it completely separate from your home loan because they've got two different purposes and two different tax benefits to it.
Awesome. Yeah.
So, but accessing that 300k is as simple as a normal home loan application. We're just not borrowing the money to buy a home. We're borrowing the money to get that 300k out for whatever the purpose may be.